Good afternoon, everybody. Thank you all so much for joining us this evening for our 1031 presentation. Just before we get any further, I just want to do a quick sound check. If you guys don't mind, for those of you that are in front of a computer, if you don't mind typing in the chat box just that you can hear us loud and clear. That way will give us the green light to make sure we can move forward and everybody can hear us. Okay, so I'll wait for a minute or two. Okay, I'm starting to see some folks reply, so thank you for that participation, really helpful. Awesome. Well, thank you again, guys, for joining us this evening. Really excited about tonight's presentation, as those of you who may be familiar with 1031 exchanges or may have never even heard of the term before. It is just an amazing presentation where so many folks work so hard to buy real estate and save and do all the right things, and when you go to sell, if you're not careful, you'll be met with quite a significant tax bill. And the nice thing is there is a way to avoid that. There is a way to defer that and to make sure that you can keep rolling that into the next opportunity and to get bigger and bigger opportunities as time goes on. So Dino from Asset Preservation is going to be able to dive into the details of it. But yeah, this is a fantastic presentation, and we're really happy to be able to partner with her and her firm. Before we kick it off to Dino to dive into the 1031s, I just want to quickly kind of go over some Marshall Reddick information for those of you that may be new to Marshall Reddick. So Marshall Reddick Real Estate, for those of you that are new, or this is maybe your first presentation, we are a full service real estate firm. And we have four primary service that we focus on. We have our brokerage, our property management, our private lending, and our investment funds. So for real estate brokerage, right, we help people buy and sell, whether that's their primary residence or investment property. For those of you that are interested in investment property, we have our property management division. So I would say 99% of the folks that do end up buying a piece of investment property do look for property management, so that it's a necessary part of the process to allow you to scale. Most of you folks are working full time and have plenty of other things outside of investing in real estate to deal with. So property management is a great partner and to help take care of those things. So we would handle everything from A to Z. That's from marketing the property, rent collection, rent disbursement, any kind of maintenance requests, as well as end of the year tax documentation that's required. We would be able to provide that information to you as well. Our third service is private money lending. So we do offer lending for those individuals that need private money. Again, this is not your conventional type of financing that you may see ads on online or on TV. This is very different than those conventional lenders, where we are not limited to the same guidelines. Let me give you some example of typical folks that borrow from us. These are going to be folks that are looking to do like fix and flips on a house. So maybe buy a home, renovate it, and then sell it, or maybe refinance into more long-term type of debt. Maybe there's like a bridge loan situation where you just need to buy this home with you don't have all of the capital put together now, but in 1 year, 6 months, 3 months, you'll have the capital or more long-term financing. That would be another example. Or another really common example is those folks that have self-directed retirement accounts, and you may want to buy a piece of property within that retirement account. You would need a private money loan, or more specifically, a non-recourse loan. So those are that's the kind of financing that we provide, and it's something that we has definitely become more and more popular given the recent restrictions and kind of turbulence that the conventional lending world is facing today. And then our third service is in our investment funds. So the flip side to that lending is that we give our investors the same opportunity to buy real estate we give them that same opportunity, but to invest their money and be the bank. You can be a lender in a first position lien. So we have two ways of doing that. You can invest directly into one mortgage, one borrower, one lender, or you can, we have a pool of investors in our mortgage fund, and we, Marshall Reddick, control that fund, and we lend that money out accordingly. And those investors that are participate in that fund will be able to receive quarterly distributions, and it's a much more passive way to invest in, definitely yielding a lot higher than a lot of what CDs or savings accounts. We've been just under about 8.69% since inception. So that's been a really good and positive service that we've been able to provide our investors. And I'm happy to go into any more of these services in more detail, post this presentation. But just wanted to give you folks a better understanding of who we are and what we do. A little bit just to introduce myself. My name is Vince Tomich. I'm an advisor here at Marshall Reddick. My primary goal is to learn as much as I can about each individual investor and just help you guide you through the investment process, and whatever that is, whatever portion of our services that is applicable to you, right? I born and raised here in Southern California, went to school in San Diego. Also, I'm a huge fan of practicing what I preach. So I do like to let everybody know that, for those investors that I end up talking to, I'm an investor myself. So it's nice to be able to kind of connect on that level. Prior to my role here, I was in residential lending, so I'm pretty familiar with the lending terms and scenarios of conventional lending, as well as what we offer from a private standpoint. And I also, I raise capital for our mortgage fund that I briefly described. I also have a position in that as well. So again, it all goes back to being, practicing what you preach and being involved in the day-to-day of what we do, and helping, folks like you who may be interested in exploring some of those options. So, we like to host these events. Education from Marshall Reddick is completely free. And what we like to do, after the presentation is do some follow-ups and to engage with you folks to see how we can help, right? Maybe you guys are just tuning in because it's your first time hearing about Marshall Reddick, and you want to learn a little bit more on that front, and that's exciting. And what you can expect from me is I will be doing some follow-up after, and the goal is to just learn the who, what, when, where, and why, right? We're just curious, how you found us. What are you looking to do? Why would you be potentially interested in investing, whether it's real estate or lending, and what kind of criteria, right? Are you looking for single family homes? Are you looking for multifamily? Time frame, is it something that maybe you're interested in doing now? Or is it something that, down the road? How do you plan on buying or selling these properties, right? Is it cash? Is it through a conventional loan? Is it via 1031 exchange, which we're going to cover, right? And then, another really big part of this whole process is, a lot of folks consider Marshall Reddick a one-stop shop, and it's really important to understand the who. Who are you working with, right? Oftentimes, the connection to Marshall Reddick starts with somebody like myself, who's an advisor and real estate agent here at Marshall Reddick. But ultimately, there's a lot of key players that are involved along the way, from our lenders to our real estate agents to our insurance folks, 1031 exchange accommodators, et cetera, right? We have a lot of folks that we have worked with for many, many years, and we're happy to make those connections and to make sure that everybody has a great experience, and you're able to leverage the relationships we've built over the many, many years. So for those of you that are, kind of curious of where Marshall Reddick is, we're located in 5 states across the country. You'll see, these little pinpricks of where, we have a physical Marshall Reddick presence, right? So brick and mortar office, real estate agents on the ground, property management services on the ground. So we have this is where we have our presence, and we, do a ton of investment property sales, particularly in Texas, Tennessee, and Florida. We do lots of local business here, right? For those of you that are in Southern California, we do property management. A lot of the services here are more primary purchases, but for those of you that are interested in investing here in California, we're happy to assist on that front as well. So this is just a good visual of where you can expect our services and where we would be the most effective for you. And then as far as where, how did we choose where to invest? Where did those markets come from, right? So, ultimately, I think we can all agree not every single market across the country is going to be a great place to invest, right? There's going to be pros and cons, and we feel that we've put together this, key criteria that makes a successful market. And some of the, they're listed here on the screen, right? We want to have a strong job market. Low vacancy rate is important. Economic diversity, just not to lean on one type of industry or one employer is really critical. Housing affordability, right? So for those of you that are located here in California, home prices are definitely above the average, and it makes investing a bit more difficult or a bit more challenging, at least if you're just trying to get your foot in the door or with minimum down payments. So opening your options up to other places in the country could be extremely beneficial. It's definitely how I got started, and it's definitely how a lot of folks that I've worked with got started. Another important factor is landlord friendly. There's a lot of states, including California, that tend to be more tenant friendly, and that it just poses its own challenges. So, being in markets where it's more landlord friendly is definitely advantageous to you folks that are, looking to expand or get into this industry. Good schooling, strong education is also important. And then last but not least, reliable property management. You want to make sure that you have access to individuals who can properly manage and service the property, know the rules, know all of the intricacies that are in that market, because it's not all that challenging to close a 30-day escrow. Where the real challenge is the year, the month to month, the day to day, and the year to year operations of managing a property and making sure that rent is paid on time and it's taken care of, and things are done accordingly, and ultimately to make sure you stay out of court and stay out of trouble. So property management is a huge resource there, and we're happy to be able to provide that. So I appreciate you folks kind of listening to me of what Marshall Reddick does, and this would be a good time for me to introduce Dino, who I've worked with very closely on many transactions. She's been a lifesaver to a lot of clients, and we're really excited to have her present tonight. So Dino, I'll let you go ahead and take it away.
Thanks, Vince. Hi, everyone. Hopefully you're having a good start of an evening. All right, so we're going to cover the 1031s. What I'm going to be able to cover this evening in this presentation is going to be a broad overview. I'm not going to be able to address every nuance to the 1031 process, but I want to just kind of give you an idea of what to expect when you're dealing with a 1031 and why people do it. So I'm going to cover, what's the capital gain? I mean, what taxes are you looking at facing when you're dealing with selling investment property? I'm going to take you through what a 1031 is. We're going to talk about like-kind property. I'm going to talk about what's known as the exchange equation. We're going to go through some of the rules and guidelines for the 1031. And at the end, I'm going to try to finish up and give you some tips that I find is important to help a successful 1031 transaction. Okay, so let's get to the meat and bones. Why do people do a 1031? Well, as Vince mentioned earlier, it's one of the vehicles that when somebody is selling investment property, they have an option to defer the tax on the sale of that property. So 1031s is very, very critical and an important part of the tax code that allows an investor to basically to kind of grow their portfolio. So let's look at a little bit about what are the taxes an investor may be faced with. Well, when you have investment property, you're depreciating the property. When you go to sell it, that has a tax rate of 25%. Then there's the capital gain tax rates. There are two capital gain tax rates. There's 15% and there's 20%. Taxpayers will be dealing with the 20% capital gain rate if you're a single taxpayer and your income is more than $492,301 and above. If you're a married couple and your income is more than $553,881, then you're going to be in the 20% capital gain rate. Now, selling real estate could throw you into that 20%, okay? Then there's the net investment income tax, which we all know is the Obamacare tax, and that is tied to real estate. So if you make more than 200,000 as a single taxpayer, 250,000 as a married couple, then you're going to be subject to an additional 3.8. So as you can see at the federal level, there's 3 different taxes: recapture tax, 25%, capital gain tax, 15 to 20%, net investment income tax of 3.8%. And depending on which state you're in, okay, you're either paying 0 taxes. So if you're a resident of Texas or Florida, for example, that would be 0 at the state level. But if you're in California, your tax rate could be as high as 13.3%. So those are the taxes that an investor is looking to face when they're selling investment property. So this is why people consider doing 1031s. So anytime you're dealing with a transaction, there's always going to be pros and cons. So let me just go quickly over what some of the pros of doing a 1031. Well, the biggest pro is what? I am deferring paying capital gain tax, depreciation recapture tax, net investment income tax, and for Californians, the California state income tax. So if you think about it, if I have $100,000 worth of tax liability, that $100,000, instead of giving it to Uncle Sam and then to the state, I can use that $100,000 to go buy more property. So that's how you help build your wealth, okay? Because you're preserving equity. So if instead of me paying those taxes, I'm using that money that I would have had to pay taxes along with the rest of the cash to go buy more property. So I'm preserving my equity. A 1031 also allows you the opportunity to utilize leverage to build your portfolio. So that's an advantage of a 1031. Diversification, which we see a lot of, is where people are diversifying geographically. They're also diversifying by asset class. When you think of a 1031, it's not just, you know, when you saw the map that Vince had there, 1031s is a federal tax code. So if you're selling in California, you can exchange into Texas or Tennessee or Florida, somewhere like that. All right, so it gives you diversification geographically. And another advantage right now, while if they change it, is an estate planning tool. So if somebody has been doing exchanges their entire life, and when they pass away, their heirs will inherit the property. When their heirs inherit the property, they get what's known as a step up in basis. So in other words, the value of that property at the time of passing is now elevated to whatever the market value is at the time. So if an investor has been doing 1031s all this time, then the heirs will inherit the property. They'll get a step up in basis. So they'll have a new basis in the property, and the tax that the investor has been deferring is not passed along to the heir. So that's one of the advantages. Now, if they change the tax code, then that could go away. Now, with pros, there's always going to be cons. So one of the cons to doing a 1031 is you're going to have specific rules and time restrictions, which I'm going to cover in this presentation. Another downside to a 1031 is you do not get a brand new basis in the property. And if you're not familiar with the term basis, that means what did you pay for the property plus all the adjustments, such as capital improvement and depreciation. So when you're doing a 1031, the basis at the time of for the value of the property you're selling moves with you to the new property. So that is one of the downsides to a 1031. So in other words, if you sold for 500,000 and your basis is 2, and you bought for 500,000, your basis is not 500, your basis is still 2. So that's a disadvantage to a 1031. Lack of liquidity, because you have to buy real property. Any money you keep is going to be taxed. You want to make sure, you know, that when you're consulting your advisor before you do a 1031, because if you have some losses and you do the 1031, well, it's not going to work in that transaction. So really important to make sure you talk to your accountant. And then obviously there's the possible risk of higher taxes in the future. So you just have to keep that in mind, that that's always on the horizon. And again, this is tax deferred, it's not tax free. Okay, so there's nothing's free about a 1031. You're basically deferring the tax on the sale of that asset. At any point in time, you can decide to pay. Okay, now, I said there's going to be some guidelines to the 1031. So there's 4 basic guidelines. The first guideline is going to be the property qualification. So is the property that I'm selling property that I held for trade or business or for investment? That's a requirement for a 1031. The second requirement is how much money you have to spend. which I alluded to, the exchange equation. So when you're doing a 1031, sometimes people are under the impression that all they need to spend is the gain dollar amount on the sale of the property, or only the cash coming out of the sale. That's not a reality. When you're doing a 1031, you're having to purchase property or combination of properties that are either equal to or greater than your sale price minus the closing costs. You have to spend all of the cash and you have to replace the debt. So that's the second requirement. The third requirement is the timeline. Regrettably, the government doesn't give you forever to do this. Believe me, there are moments where everybody wish they did, okay? You have 45 calendar days to identify from the date of the closing of the sale, and then the 180 days to complete the exchange, which also starts at the closing of the sale. And then the fourth requirement is that you have to identify the property or properties that you're going to purchase in the exchange. So this is what I'm going to cover through the basics of the 1031. Okay, so let's talk about the first requirement. I'm sure you've heard the words like kind property. And sometimes people get caught up and think like kind is literal. I mean, I've had it so literal. Sometimes people go, well, I'm selling a 2-bedroom, 2-bath condo. Do I have to buy a investment property? Do I have to buy a 2-bedroom, 2-bath condo? The good news is no, but you do have to buy real property. So when you think of the words like kind property, think of it this way: investment real estate for investment real estate, or property that you're operating your business out of, and you're going to buy another piece of property that you're going to operate your business out of. But it must be real property. So as you can see, the term like kind property is not that literal. Just think of it as investment real property for investment real property. So this gets to our talk about diversification. Maybe I have raw land that I've held for investment. Well, raw land typically is not going to produce any income. So I sell that raw land and I turn around and I buy maybe 2 or 3, single family rentals. Or if I have an apartment building, I may want to buy a single tenant, triple net commercial property. Very broad in the terms like kind property. Now, one of the issues that comes up in the 1031 is, people sometimes think when they sell their primary residence. So I'm just going to touch on this very briefly. If you're living in the property and there's absolutely nothing else going on with that property, it's your primary residence, you have, under the primary residence tax code, you have tax-free $250,000 if you're a single taxpayer, $500,000 if you're a married couple filing a joint return. Now, I'm using the words tax-free because it literally is tax-free. Any gain above that, you're going to pay tax on. So sometimes people get the impression that they can do a 1031 with the excess gain on their principal residence, and you cannot. You also cannot buy a principal residence in a 1031. And then another component that does not qualify is property that's held for trade or property that's held for fixing and flipping, so dealer property. So Vince talked about some of the financing that they can do for people that are going to buy these properties that they fix and flip. A fix and flip is not available for a 1031 because that's considered inventory. It's not considered investment property. So again, property that you have held for trade or business or for investment. Now the big question comes up, well, what does held mean? How long do I have to hold it? Well, there's nothing in the tax code that mandates that you hold it for a specific period. So if you have an investment piece of property, I get this question all the time: how long do I have to hold it in order for me to qualify for a 1031? Well, you're going to talk to your tax advisor because that's the party that's going to really direct you as to whether that they feel that you have established that you held that property, that you had the intent to hold that property for investment purposes. So you've probably heard, well, I have to hold it for 2 years. Well, that is one of the schools of thought, right? If I hold it for 2 years, it's on 2 or 3 of my tax returns. There was a revenue procedure that came out about vacation homes that said if you own the dwelling unit for 24 months, the sale, the one you're selling and the one you're going to buy, then that would qualify for a 1031. So sometimes people look to those things to determine, is 2 years sufficient? And then there's some tax advisors that, maybe a little bit more aggressive. They go, well, you've had this asset for more than a year. So now you're in long-term capital gain, unless you're a dealer. So maybe a year sufficient. it's up to the tax advisor to determine whether they feel that the investor has actually held the property for investment purposes. So when it comes to this, people go, all right, well, do I have a mandated period? Not necessarily. Okay, it's between you and your tax advisor. All right, so now let's get to the next requirement for the 1031. Okay, we call that the exchange equation. So with the exchange equation, as I mentioned earlier, you have to buy property, so your target would be, if you're trying to go for full tax deferral, you need to purchase property that's equal to or greater than your sale price, minus the closing costs, spend all of the cash, and replace any existing loans. So here's my first example. Sold the property for $900,000. The loan at the time of the sale, it's not when you got the loan, it's whatever it was when you paid it off at the closing. Say in this example here was $300,000. The closing costs were $60,000, so that the cash coming out of the transaction was $540,000. Buying a property for $1.2 million, putting all the $540,000 down, utilizing leverage to buy higher. So that's an example of utilizing leverage. So they got a loan of $660,000, so they replaced the loan. So in this example, there would be no boot because they've met the requirements. Okay. Now, here's an example of what's known as a partial exchange. Somebody sells a property for $900,000, but they only want to buy something for $700,000. So one thing about the 1031, and it does come up often. In fact, before we got onto this webinar, I had a call. Someone was asking me, can you buy less than what you sold for? And the good news is it's not an all or nothing system. So if I decide as an investor, I want to buy down in value, I'm going to be subject to tax on the portion I'm not reinvesting, but I still may be benefiting from the 1031. So I'm going to be exposed to some level of tax, so you can do what's known as a partial exchange. So here's my example, which is going to show you what a partial exchange looks like. If you're familiar with 1031s, you've heard the term boot. All boot means is taxable. That's all it means, is that you're going to be subject to tax. There are two types of boot in a 1031. There's cash boot, which means you did not spend all of the cash, which is sort of a no-brainer, right? Because that makes total sense. But then there's mortgage boot, if you don't want to replace the mortgage. So, and this is the one that gets stuck for a lot of folks because they go, well, wait a second, I didn't get any cash. I understand, but a mortgage is cash that belonged to somebody else. So in my example here, they bought for $700,000. They only acquired a loan of $260,000. So the mortgage did not get replaced to the tune of $40,000. Only put $440,000 cash down. So there's $100,000 worth of cash boot. So in this example here, the taxpayer would be subject to paying tax to the amount of gain on $140,000. So if you're considering doing a partial exchange, it's totally fine, but you want to do an analysis to make sure that you're still benefiting from the exchange. So in other words, that your gain amount is not less than the boot amount. Because if your gain amount is less than the boot amount, then there would be no reason to do a 1031. So my point to you is that if you're considering this, do the analysis. So if you were talking to me, we would go over all the numbers. And then here's something that's really important, where sometimes people get focused on the wrong thing. They're focused on, well, I have to buy higher, and forgetting the other part, that you have to spend all the cash. So in this example here, again, sold for the same $900, same loan amount $300, same cash of $540. But because they had such great credit, they go, oh, well, I can get a $700,000 loan, and I only put $400,000 down. In this example here, because they did not spend all of the cash, that $140,000 is going to be taxable. You see, you cannot keep cash and get a higher loan if you're buying higher. So it's really important that when you're buying that replacement property, you're watching these figures, okay? So just be aware of that. Now, let's go through, what is considered acceptable closing costs in a 1031 and what are not. Well, any cost that's associated with the transfer of property. such as the real estate commission, any title insurance premiums that you're having to pay, paying the, your portion of the closing fees or the escrow fees, any legal fees associated with that transaction, transfer fees, notary fees, recording fees, the qualified intermediaries fees. Those are all costs of transferring the property. But there's times where you may be subject to having some costs that are not considered acceptable exchange expenses, such as prorated rents and security deposits. Prorated rents and security deposits would be an operational function, not a transfer of property, okay? So if you're crediting the buyer, for example, with any prorated rents and security deposits, that means the buyer's bringing in that much, they're not bringing in that amount of money because you're crediting them, and that is going to be subject to tax. When you talk about lender fees, such as points and prepayment penalties, those are all a function of buying money, okay, not of buying the property. Well, the money is buying the property, but you get my point. You're paying for the purchase of the money. Paying the buyer's closing costs, that can be subject to tax. Any lender policy, title policies, impounds such as property taxes and insurance. We see this obviously more on the buy side because lenders are requiring impounds. So sometimes people go, I want to use my exchange proceeds to fund the impound account. Well, that would be considered boot because that's not something that you're not buying the property, you're funding the impound account. So there are certain things that are considered acceptable exchange expenses, and there are some that are not. One of the issues that have come up recently is people wanting to be reimbursed for the preparation of the property for sale. And they maybe had to spend $10,000 or $15,000 and they want to get that money back. And so they go, okay, well, I want to get my money back at the closing. Well, if you take that money back at the closing, you have to understand that that is going to be subject to tax. How your accountant deals with that, that's going to be, the settlement of your tax return. All right. So we've gone through the first two requirements, the property requirement and how much you have to spend. Now let's kind of take you through the exchange process itself. So what happens is when you get ready to sell the property, in my opinion, it's really important that you talk, you're obviously going to be talking to a real estate professional about, what's going to be the market value of the property, all of the good stuff associated with the sale. But it's also important that you talk with your tax advisor so you can determine whether you need to or you should be doing a 1031 based on your tax situation. Because you can talk to me, you can talk to Vince, but we're not going to know everything that's on your tax return. And your accountant or your tax preparer is going to know everything that's on the return. And then that person can guide you saying, yes, I think you need to do a 1031, or you should do a 1031. Or maybe there's an instance where he says, he or she says, no, you don't need to do a 1031 because you have all these losses over here that will mitigate any tax liability on the gain. So it gets a little complicated. So really important when you're considering selling that property to talk to your tax person to determine what's my gain and how much will I pay in taxes if I don't do a 1031. Now, my role as the qualified intermediary does not officially begin until you actually are in contract with a buyer. So once you open up escrow, that's when my role comes in. So you see the real estate agents, all the documents from the real estate side. When you open up escrow, you're going to see all the escrow documents. You have to set up the exchange before the sale closes. So let me repeat that. You must set up the exchange before the sale closes, because we as the qualified intermediary are going to prepare the exchange documents. If you have no exchange documents that are fully executed and you close, you have a taxable event. You cannot unwind anything you've done at that point. So my role begins when you open up escrow. All right, I would be reaching out to the escrow officer requesting a copy of the contract and the title information. Then we prepare the exchange documents. You sign the exchange documents, and then when the buyer brings in the funds, the deed is going to go directly to the buyer. The money is going to come to the qualified intermediary. So the date of the closing starts the time frame for the exchange. So this is when you're getting into that third requirement about how much time do you have. You have 45 calendar days to identify, and I like to say an additional 135 days to complete your exchange. These are calendar days, not business days. Calendar days, not business days. So you're going to be watching these time frames very, very closely. When you get in contract with the replacement property, we have to be assigned into that. So we're going to prepare the replacement property exchange documents. So we're going to need a copy of the contract. We're going to need to know who is handling the closing of the purchase. Then we're going to prepare the replacement property exchange documents for signature. When you're ready to close, we're going to wire the funds in, and then the deed is going to go directly to you as the investor. So that's the flow of the exchange. And I am coming at this very fast, but these are the critical components to the 1031. Now, let's get down to what's the hard part in the 1031, and that's the 45-day identification period, because you have to identify what you're going to buy within that 45-day period. So let me explain what I mean by identify, because sometimes people get confused and they think, well, if I'm in contract with the property, or if I'm making offers on a property, that is the identified. Not necessarily. Identification is a technical part of the exchange, and it's a very critical part to the success of an exchange. You must fill out an identification form. So your contract is not that form. So there's a form that we provide the investor to say, okay, you're now going to fill out on that form the address, the city, and the state of the property or properties that you would like to purchase as a part of your 1031. Okay. Now, people say, well, how many properties can I identify? Well, there are 3 rules. But you can only select one of the 3 rules. The first rule is known as the 3 property rule, where you're physically limited to 3 addresses, but you're not limited to dollar amount. So if I sold for $900,000 and I identified 3 properties, I can identify one for, $900,000. I can identify another property for $1.1 million. I can identify another property for $1.2 million. And then buy whichever one, or buy 2, or buy 1 and 2, buy all 3. If I want to identify more than 3 properties, I'm moving out of the 3 property rule, and I'm moving into the 200% rule. The 200% rule means I'm identifying 4 or more addresses, but now the values of those properties are going to come into play. I am going to be limited in value, combined values of all the properties, to 2 times or 200% of my sale price. So if I sold for $900,000 and I identify, say, 6 properties, the aggregate values of all of those properties cannot be more than 1.8 million, and then I can buy whichever combination I need to meet my exchange. If you identified, say, 6 properties, but the aggregate values exceeded 1.8 on a $900,000 sale, and say the aggregate value is $2 million. Now I'm out of the 200% rule, and I'm into the 95% rule. And just to make the 95% rule, what it is, you must close on everything you have identified. So you want to stay away from the 95% rule. So sometimes people will ask me, well, what rule am I going to be able to use? I say, well, okay, how much are you selling for, and where do you plan on purchasing? So if you're selling in Newport, for example, for $1.5 million, but you're buying some single family rentals in Clarksville, Tennessee, or in Ocala, Florida, well, those single family rentals may be like $250,000. So theoretically, you can identify more property because you're buying less in value, so you're going to need to identify more. But if you're selling in Newport for $1.5 million and you're buying in Newport, you're probably only going to be able to utilize the 3 property rule. So when you get in these situations, just be aware of the moving parts. And this is what we try to help you go through and guide you through this process. So what constitutes an identification? Has to be in writing, must be unambiguously described, has to be hand delivered, sent. Okay, so basically we get them in faxes, or we'll get snapshots on an iPhone that's sent in, okay, by midnight, okay, of the 45th day. So if that 45th day falls on a Saturday or Sunday, you cannot wait till Monday to get it in. You must get it in by that date. I always recommend when the 45th day falls on a Saturday or Sunday that you get it in the business day before, during business hours. So that way we can look at the identification and make sure you've got it complete. Now, we're not going to know if you've got all the addresses correct, especially if you're not in contract with anything. But there are times where people write down the address, but they forget the city and the state. It must be address, city, and state. So if you do it before the 45th day, then we can help you fix that. If you send it in at, if it's due on Sunday and you send it in at 11:30 at night, we'll clock it in at 11:30 at night, but we're not going to see it until Monday. And if you didn't do something right, you cannot fix it. So really important. Understand that the identification is really, really critical to the success of a 1031. So this is what an identification form looks like. It's basically just a piece of paper that you're going to fill out the address, the city, and the state. Sign it, date it, and get it in. Okay, so that's what the form looks like. You're usually going to fill out this form when you get closer to the 45th day. Sometimes people go, well, I want to fill it out right now. Well, you can, but what if that deal falls out? Now you have to revoke and you have to replace that list. So you just want to wait till you get a little bit closer to the 45th day. By that point, hopefully you have a good solid transaction, and then it'll be a no-brainer. Okay, easy peasy. Okay, now there are times where people are looking to consolidate. So we're going to go, you can sell multiple properties to buy one property. So just going to cover this quickly, is that if you want to sell 3 properties to buy 1 property, all the guidelines and everything remain the same, but you have to understand that the time frame for the exchange is going to begin at the closing of the first property. It's going to begin at the closing of the first property. You cannot close on your purchase until you have closed on all of your sales. So if you're considering something like this, timing is going to be really important, and you want to make sure that you're able to successfully do this type of transaction. Now, we see this, but we see more of this, where somebody is selling 1 property and they're buying multiple properties. And the key with the buying of the multiple properties is just be aware that you have to make sure that you're closing on your last purchase within the 180 calendar days. So this was the fast version of a 1031. But what I would like to go through right now is what I call my tips for a successful 1031. And one of the most important things that I see in a 1031 transaction is that if a taxpayer is not consulting their tax advisor prior to 1031, they don't understand how important getting that their advisor involved is into the transaction. As I mentioned earlier, because do you need to do a 1031? That's what your advisor is going to tell you. Your advisor is also going to be helping you review those closing statements, so the CDs and such that you're going to be getting from escrow, to look at it. Okay, yeah, this item here, you're probably going to pay some level of tax on. They can interpret what they're telling you, that, I want you to bring in this money. I want you to handle this a different way. So you want to make sure that you're consulting your tax advisor early. All right, that's an invaluable tool for the success of a 1031. Discuss the 1031 with the qualified intermediary. That happens more often than not, truthfully. Okay, but you want to have that conversation not 3 hours before your sale's ready to close. You really want to have that conversation when you're getting to the point of, say, maybe listing the property. Or okay, because we're going to tell you what the rules are. So if you give me a call and say, oh, I'm considering a 1031, I'm going to go over everything I just went over, but I'm going to now fine tune it to your transaction. So we're going to help you get educated on the rules, the guidelines, what to expect. What are you going to see? All right, you're going to see the exchange documents that are coming out. We need you to sign these documents and return them by a certain date. So we're going to give you all of those guidelines. We're going to walk you through the process. So that way you know what's coming. The next is going to be familiar. So know what that tax requirement is for full tax deferral. Okay. I like to tell people that when you're involved in a 1031 and you're working with a 1031 company, you need to talk to the 1031 company. If you have questions, go directly to them about, say, full tax deferral. Talk about what's happening, how to properly identify. Don't talk to your friends. Don't start surfing the web, because that can get very confusing, because I can't tell you and I hate the word, but the misinformation that can be, or misleading information that can be on the web. It can be misinterpreted really bad and could have a negative impact on your 1031. So become familiar with this. I like to say that when you're doing a 1031, this is sort of like your new full-time, part-time job. Okay. You have to stay focused on what it is you're doing, because the goal is you're trying to defer the tax on the sale of the property. Now, the next would be, and this one's an important one, is confirming the tax ownership and the vesting prior to selling. I would like to say this is rare, but it's not. A lot of times as an investor, maybe when you bought the property, you have it titled one particular way, that the vesting, but you may have changed how you've reported it. So maybe you have a husband and wife that bought a piece of property, and your accountant says, you know what, I want you to turn this into an LLC that's taxed as a partnership. But you never bothered to change the title, and you've been filing your tax returns as a partnership. Now you're going into a 1031, and you're telling me that you own it in an LLC that has been taxed as a partnership. And now I'm looking at the title, and the title is, Joe and Jane Smith. Well, the tax reporting does not match the vesting. So it's really important to look at your vesting, confirm with your tax advisor, does your vesting match how you're going to be, how you've been filing. This is something that we see too often in a 1031. And generally when we see this, we're like a week or two before the closing. So if you can address these issues when you're getting ready to sell the property, that helps a lot, because now your contracts are in place and everything's proper. The title is now going to be proper if you take all the steps that you need to correct any errors that may be on the title to how you've been reporting it. And then the last one is communication. It's so important that you're communicating throughout the entire transaction. It is your transaction, so be proactive. If you're not sure about something, or you're not understanding the answers you were given, keep asking the questions until you get a clear understanding of what is going on. So be proactive. This is your transaction and you want it to be successful. Keep in mind those timelines. They go by very, very fast in a 1031, especially in a low inventory market. So always be advised of what the timelines are. When is your 45th day? When is your 180th day? When does it fall? All right. And again, stay engaged in your transaction. I know when you're doing these things that you're working with a lot of different people in the transaction itself. You're working with escrow, you're working with the lender, you're working with the real estate professional, but you still need to stay engaged because it is your transaction at the end of the day. So those are the basics of a 1031. There's a lot more to the topic. And so, feel free to reach out to me if you have additional questions, and I'd be more than happy to answer them on your behalf. So I will now turn it back over to Mr. Vince.
Thank you so much, Dino. That was very, very educational. There's so much to that, that even myself have listened to this presentation multiple times that I gather and pick up. I'm seeing some questions coming in, and guys, to be honest, some of them are, I don't know if we're going to be able to get to many of these. I am seeing them, and what I can do is make sure that we are getting these answered at some point. I know we covered them, a few of them now that I'm reading them. But don't worry, if you don't get your questions answered tonight, I will assure you that we will go ahead and make sure to get the proper questions over to Dino or myself and get those answered for you guys. I just don't want to take on kind of personal questions, amongst the group here. So just really quick as we close this out, what you're going to see is our Marshall Reddick rating ebook here. This is just basically something that you're going to notice on any property that we have on our website, any investment property. There's going to be a property class that's tied to it. And there's going to be a property class tied to it, and this book will help explain what that property class means in terms of setting proper expectations, from basically luxury to D class properties, and what to expect from a maintenance and vacancy standpoint. So this is a super helpful book for obviously those of you that are taking the time to be on this webinar tonight. Value education, and this is another piece of free education that you may be interested in. The rest of our articles, guides, videos, past webinars, you're going to be able to find that all for free on our website under the Learn tab. Learn and then Education. You'll be able to watch previously recorded webinars that ultimately you guys can dig into a little bit more. Again, here's my contact if you guys are interested in scheduling a consultation or having any questions. I did get a couple questions of getting to Dino's contact. So what I'll do is, before we shut this down, I'll let you guys take a minute if you need to jot down my information. And then what we'll do is I'm going to back it up just so that I can leave it on Dino's slide, just so that for those folks that are still here that want that information, I'll let you guys jot this down so you have it one more time. But yeah, this was an amazing presentation, Dino. We so value your partnership and taking the time here. Again, I will be doing follow-up calls starting tomorrow. So you can expect a phone call and email from me. And what we'll do is we'll make sure that we're getting your specific questions answered. And if it's more of a setting up an appointment or kind of a group call with Dino, I've done those many times, and she's been really accommodating. So best way is to probably set up that via email. So we'll be reaching out to you folks tomorrow. But again, Dino, I wanted to thank you so much for taking the time tonight. Super valuable.
My pleasure. My pleasure.
All right, guys. Enjoy your evening. Thank you guys so much for attending. Good night.